Hello, I'm Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. I know this format is normally what I use for my short videos, but I assure you this video is not going to be a short one. Earlier I posted a short video regarding the Euro-USD market and the insanity of today's session. I want to talk more about that and some of the decisions that I've made with my own personal trading and the consequences of those decisions. So let's get straight into it and talk about today's market. As you can see, it has been insane. All the way around, totally crazy volatility. That has been great for people with long positions and absolutely disastrous if you're holding a short position. Typically speaking, I trade shorts only, which means I took 9 stop losses today, or basically $90 loss. It hurts, but it's not the end of the world, because I know from my own personal experience of trading forex over the last 7 months and cryptocurrencies for the last 3 years. These type of movements are extremely rare. And that really is the point of how I made my decisions. For example, since I started trading at the beginning of the year, I've placed 3,351 sell orders or profit orders, and I've taken 37 stop losses. Basically, just shy of a 1% amount between stop losses to profits. Now, that is, of course, strictly to this market, and every market will have its own dynamic. But I found for me that this works very well. So 85% of my time, the market is either going downwards or sideways, where I am making money. I only have to worry about 15% of the time when the market does this type of stuff, and really even less than that, because I can usually make up 2 or 3 stop losses in 1 or 2 days of trading. But when you get 9 back to back, obviously it's going to take significantly more time to recover. The process that I used here, and I mentioned it in my last video, is that my units are stepped with only one position difference, meaning the first price and the lowest price are fairly consistent, and I'm going to demonstrate that. For example, my highest position on the screen is $473. So let's go here and let's demonstrate what that really means. So a 473 unit size means my take profit is going to be 47 cents and my stop loss is going to be $9.46. So that is a drastic difference from the way I normally trade. But if you figure I'm only going to take a stop loss 1% of the time, and the other 99% of the time I'm going to make up the difference with 47 cents roughly per trade profit, it makes sense. But I did mention though that you could use a stepping system, meaning the highest level of your grid could be 10 times more than the lowest level of your grid. And that would mean that my unit size on the bottom of the grid would only be a 94-cent stop loss. So basically using this approach where you have a step between the low and the high that's so drastic, a couple of high-level profits would make up the difference for the low-level losses. So it's a trade-off. The trade-off is consistency in price or consistency in profitability versus the advantages of being able to recover quicker from a smaller number of losses. And that consistency shows up when you trade more than one pair. For example, I trade two pairs. I trade Euro USD and I trade USD Canadian. And its market is inversely correlated with Euro USD. So while the Euro USD market is going crazy, the USD Canadian market is going down. But because I'm using the 1 unit distance sizes between each position, the profits I'm getting as the market drops for USD Canadian is still consistent within what I expect. For example, 427 is my high. So let's put that in. And you see that my profit should be around 43 cents. So every time I sell a position on USD Canadian, I am making roughly 40 cents, give or take a little slippage. So even though I am consistently at $10 per a loss on one pair, I am consistently maintaining the profitability on the other pair as it drops in value, versus only 4 cents take profit. So I'm making up the difference by hedging my profitability between both pairs. Now, if I was only trading just the Euro USD, then I probably would use a stepping method and I would commit my entire balance to that one single pair. But the consequences of that is my profitability would be 1/2 of what it is right now. See, right now, Euro USD makes about $3 a day profit for me. And USD Canadian makes about $3 a profit for me. So I make on average $6 a day profit between both pairs, with them being consistent across the lower to the upper boundary. So by using this technique, I've really doubled the amount of profitability I would normally get with just one pair. Now, if I was to use a single pair trade only, where my lower boundary is 10 times less than my higher boundary, well, on very good days like today where the market is at the high boundary, I could make $14 or $15 in one single day. But if it was like US Canadian right now, I would only be making $1 or $2 for that day. So as you can see, it is critical that the consistency of the market for my own risk measure was something I had to consider. Even though I'm not going to make as much money on the really nice days of $15 a day, on the normal days, which is about 70% of the market, I'm going to make more money using the consistency level. And because my stop losses only occur 1% of the time, I'm more likely to be more consistent longer than the short-term losses I'm going to feel. So even though today's $90 hit hurt over the course of the normal trading cycles, I will make that back and then more because of the consistency of my trading approach. 37 stop losses versus 3,300 profitable trades. This is the kind of information that you get out of a demo account, and how you're able to determine reasonably what works well for your personal situation. So as you progress and begin to understand market dynamics, you will begin to see just how critical the relationship is between the profitability of your grid and when and actually if you take a stop loss at a given turn point. So overall, while today has just been crazy insane, this market is going to reverse. And when it does, if the volatility continues, these will make up a huge amount of the losses I've made. I could potentially make up a third to half of this just in one day from volatility. So 2 days to a week, I will have recovered everything I've lost, typically speaking. But either way, from the long-term perspective, I will recover my losses. And that is the significant reason why I chose consistency and uniformity over a distinctive low-high separation. So as you plan for your trading, these are just some of the things you need to think about. If your profits are consistent in the amount you are going to make each trade, then your losses are also going to be consistent over the amount you make for each trade. That really is the significance of your risk management. For example, I know my stop losses average $10, or roughly $370 I've taken so far. Looking at the examples I just demonstrated, my average profitability is going to be 40 cents. Or basically $1,340 of profit versus $370 of losses. So, how much am I going to make over the long run? Well, just since I started trading using these metrics, $970 of profit versus $370 of loss. So even though a take profit of 10 pips versus a stop loss of 200 pips sounds insane, the actual trading, the real consequences of what the market does, shows significantly that I'm going to profit more in the long run statistically. So take your time and think about your risks. All of this is about risk. And the one thing that you have to really consider in your risk is your margin. The 9 stop losses that occurred to this day, or this morning, they cost me roughly $4,500 of buying power because I am fully leveraged at 50 to 1. So as you can see from my budget, it took a hit. My realized losses are quite substantial compared to what they were. That is something you have to think about, again, in evaluating your risks and determining the situation that works best for you. These are just some of the considerations. But when you look at the realization of your activities, you see reasonably well how your bot is going to respond and behave appropriate to how each step functions. In this case, the bot has been doing beautiful. It's been protecting the margin. As I'm very far away from a margin call, it's been protecting the balance because it's taking deliberate losses when it is necessary. And it is taking profits appropriate to the consistency that I want in my trading for the two pairs that I trade. And I have my stop loss set such that I am balanced between the amount of finances I am charged versus the number of positions I hold. I could take on more positions, but then I am holding positions that are simply going to rot my profits away through finance fees of leverage that I don't want. Again, this all plays together in a way that guarantees you have a metric of potential success. It all plays together in a way where you control your risk, you protect your balance, and you, in the long term, will profit consistency. I've been trading this pair for 7 months. So for 7 months, $970 of profit. That's worth it. That's realistic. That's reasonable. And let's see. That's roughly $138 a month of profit. Whereas my stop losses are roughly $52 a month. So you see the dynamic, you see the relationship between your stop loss, your take profit, and how the floating grid moves with the market. And this morning was a wicked move. Beyond, really, I've only seen this kind of a move twice in the 7 months I've been trading Forex. So it's not something that happens often. But when it does happen, it hurts. Nonetheless, I'm not worried about it. My bot has done its job. And I'm actually quite ecstatic at how well it's managed to protect my margin. That was my biggest concern. Because as soon as I hit the 50% mark, I go into a margin call. If it doesn't get rectified quickly, I could face a margin closeout. And that would be devastating. So the fact that it mitigated the entire process the way it did and recalculates everything literally as it happens is a credit to the fact that the programming is doing its job perfectly. For once, my bugs aren't biting me in the hiney. So, think about your risks, think about your rewards, think about your actual trading. Use that demo account. I can't emphasize this enough. Use it, learn from it, collect the kind of information you need to make informed decisions about your trading. Because the more information you can put into your trading, the more likely you are to be profitable in the long term. Let me know how you trade. What have your stop losses been like over the last several months? What has the market been like for you? What do you think of today's session? If you happen to be in the market for a long position, this was a wonderful spot to be. Share your thoughts. Thank you for watching, and please give this video a thumbs up. Like it so somebody else can learn some of these techniques. And until next time.